The government is set to push through legislation that stops bosses from calling or texting workers after hours. Australia's two biggest energy companies call off $80 billion merger talks, and the fight over supermarket prices starts to get a little bit nasty. Welcome to Fear and Greed Business News, Australia's best business podcast. It is Thursday, the 8th of February, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, after the show, you have an interview coming up today with Matthew Strotton, who is the Executive Director at RAM, Real Asset Management.
Yes, I certainly do. We talk all about real estate investment trusts, better known as REITs. It's a huge investing class. So we think equities, we think bonds, we think infrastructure, and we think REITs. Well, REITs is kind of complex. You might have an office building in there. You might have a Bunnings in there. You might just have the local store in there. So we talked to him all about that, what he invests in and what the outlook is like going forward. REITs, because they carry so much debt, interest rates really matter to them. So what's going to happen now that this interest rate cycle is turning? Fascinating chat about REITs, and it's such a big part of the market. You need to know about it, particularly if you're an investor.
Yeah, you certainly do. It is a really good conversation. And of course, Real Asset Management is a supporter of Fear and Greed, but it's well worth it just as a 101 on REITs, really, Sean. That's coming up later on. The main story this morning, though, good news for workers sick of fielding work emails and work calls after they've clocked off, with the government close to reaching a deal with the crossbenchers to pass legislation allowing workers basically to ignore bosses' calls after hours.
Only if we can push it to ignoring bosses' calls during working hours, then we'd have success. Yesterday, Labor reached a deal on a right to disconnect that will allow millions of workers to clock off after hours. If bosses keep calling, well, the worker can seek orders to stop them reaching out with potential fines for breaches. It is a contentious segment of the government's second tranche of its closing loopholes legislation. Other parts of the legislation includes casual conversion rights, minimum pay for gig workers, and road transport laws. The Greens yesterday said that the deal was a big win after they proposed the changes last year. Crossbench Senator David Pocock and former Green Senator Lydia Thorpe are also expected to support the bill, giving the government its needed majority in the Senate.
So talk to me about the detail of this, Sean, because basically the new legislation gives workers the right essentially to turn their phones off and ignore work calls, ignore work emails until they return the next day or for the next shift, whatever kind of comes next.
Yeah, it's been a growing cause of concern for many Australians that they can't simply log off because managers keep sending texts or emails. As Green Senator Barbara Pocock said, Australian workers today have a road to a new right, a right to turn off their phone and to turn on their attention to their family, to their health, and to join many countries around the globe that have established a right to disconnect for workers in a universe where tech is very different. We all know what it's like to get you wake up and you look at your phone and your boss has texted you, or it's a weekend and they've texted you, or it's 8 o'clock at night, and you kind of feel under some compunction to respond. I find it really irritating. And this is actually codifying the right to say you don't have to respond, because some bosses expect it, no doubt. What do you reckon Adam Lang would think about this one?
Well, this is what I'm thinking. This story is definitely going to come up in the Fear and Greed Weekend Edition, because that's the one where our colleague Adam Lang is the judge. He is the adjudicator. And I'll be very intrigued to see what he thinks about it, because he is a manager. He is a boss.
He's a 9 p.m. email man. You're always getting emails from Adam at 9 p.m., which you and I dutifully ignore totally. But it kind of looks as if he's working really hard late.
You know, the greatest thing that I have learnt to date from Adam is how to schedule an email to send. Because you know how, people can, it's one thing to have the right to switch off, but it's also another thing to be able to work the hours that are comfortable for you as well. And so that if you want to sit down and kind of churn through some emails at 9 o'clock at night, then yeah, go for it. But the fact then that you can schedule your emails to send at 8 o'clock the next day so that other people don't feel compelled to respond to them at 9:30 or 10 o'clock at night, or have their phone kind of lighting up at that time. It's a really good little piece of technology.
I reckon Adam's scheduled to send them at 9 p.m. at night, so we all think he's working really hard. I'll move on to markets. S&P ASX 200 ended a run of down days to finish 0.5% higher at 7,616 points. Interest rate sensitive sectors like utilities and real estate companies, they did best. Energy stocks did worst, a fair bit on that sector. Talk to you about that in a moment. Among the large caps, the banks were mixed, so too the big retailers. Telstra was off more than 1%, while James Hardie had a rare off day. It fell 2.2%, still up more than 70% over the last year or so. WiseTech Global and REA, they both did pretty well. The big miners were higher on the back of stronger iron ore prices. In fact, many of the miners did well yesterday, with nickel group Chalice up 8.5%, best on the day. Alumina rose 6%. Lithium miners were also among some of the better performers. Liontown Resources was up 6%. Pilbara Minerals was 5% higher after doing a spodumene concentrate supply deal with a Chinese chemical producer. Now, I'd like you to explain to me what a spodumene concentrate supply deal is, Michael.
I would love to, Sean, but I just don't think we have the time.
Good point.
Or the knowledge. That too. Probably lacking a few things here, Sean. What's happening in international markets?
Commodity prices were up over the past 24 hours, benefiting some of the local miners. Oil prices have also risen for 3 straight sessions as investors ponder potential supply disruptions from the Middle East. The Aussie dollar is trading around 65.3 US cents. Chinese markets are performing a bit better. Well, they have done over the past couple of years. In fact, they had their strongest day in a year on Tuesday. That's on the back of signs from Beijing that they want to step in to end the year-long slump in equities in the world's second largest market. And New Zealand's unemployment rate for the December quarter rose to 3%, the highest level in 2.5 years. Just before we leave economics and all things markets, we got an inquiry. We got an inquiry from one of our listeners on Instagram over the past 24 hours, Michael.
That's right. This came from Troy, and I thought this was fascinating. He says, "Hi, gents, question, as it's interesting to ponder what is the consensus. Will the new 1 July tax cuts create more inflationary issues? With more cash in hand, will consumers spend more, driving inflation?" And look, he then goes on basically to ask, what's it mean then for interest rates?
Yeah, it's a great question because a lot of the discussion has been about what these tax cuts mean for inflation. What we have to remember is most of the bureaucrats out there are talking about what it means for inflation compared to the stage 3 tax cuts, not compared to as is now. So there is no doubt the tax cuts that are coming from on July 1 will be inflationary, definitely. Will these new tax cuts be more inflationary than the stage 3 tax cuts? That's where most people are saying, no, not really. There's a finance official in Senate estimates during the week saying, it's about the same amount of money. I mean, over a few years, it's about $1.3 billion more. That's not a lot of money. So it's not inflationary compared to stage 3 tax cuts. Definitely is inflationary compared to no tax cut. The other point I'd make in this is that people with lower income who are now getting a better deal than the stage 3 tax cuts, they tend to have what they call a higher marginal propensity to consume, i.e. they will spend more of it than if that ended up in the hands of wealthier people. Now, people with lower incomes tend to spend that on necessities. So that Michelle Bullock, the Reserve Bank governor, kind of alluded to this the other day. She said it won't be a big difference. So great question. The short answer is yes, definitely inflationary. However, when you're hearing discussions recently, it's not more inflationary than those stage 3 tax cuts.
Yeah, thank you very much, Troy, for the question. We love hearing from anyone that has a question that wants. And you know what? If you send it to us via LinkedIn or Instagram or anything, sometimes I won't even tell Sean that it's come in and I'll just hit him with it. A question without notice, which I know is his absolute favourite. So keep the questions coming and we'll see if we can catch Sean out. It'll be a new sport for us. We'll be back in a moment with the rest of the day's business news. Sean, Australia's 2 biggest energy companies, Woodside and Santos, have called off plans for a mega merger, sending the latter's share price down 5.5%.
Woodside Energy Chief Executive Officer Meg O'Neill said she wasn't convinced a deal would create value for shareholders. Some large investors had voiced concern that there weren't really a lot of synergies between the 2 companies. What's that mean? Well, there's just not a lot of easy cost savings if the 2 come together. Santos really was the loser out of the announcement, with the company management now under pressure to find another way to ramp up its value. Maybe it goes and acquires something. Maybe it finds another partner. Talks began last year. They're only confirmed in December. Combined, the two would be worth around $80 billion, but it ain't going to happen.
Sean, a lot of news around in the last 24 hours. National Australia Bank has appointed 48-year-old Andrew Irvine, currently the head of business lending at the Melbourne-based bank, as the next CEO starting in April.
I reckon running one of the big four banks in Australia is about as blue chip a CEO role as they come. Probably the Melbourne banks more than the Sydney banks too, I'm guessing, and probably National Australia Bank. The dual Canadian-British citizen has been with NAB since late 2020. He beat out internal candidate Rachel Slade. She's currently head of retail operations. Outgoing boss Ross McEwen is considered one of the best CEOs of the bank in the past couple of decades, and the group's share price fell after the announcement that he's stepping down. Now, he's been in the job for 4 years. The boss of Westpac, Peter King, and the boss of ANZ, Shane Elliott, they're also expected to announce their retirements at some point this year, according to media reports. It's going to make for a very fresh-faced bunch of bank CEOs by the end of the year. And Matt Comyn, of course, is the Commonwealth Bank CEO. He's fresh-faced anyway. He could be in the job for 10 years. He'll still be fresh-faced. He just has a very young-looking face. So, I can't even say it, Michael, fresh-faced bank CEOs? Let's leave it that one.
Yeah, I'm going to leave you alone with this one, Sean, because it feels like you're doing a perfectly good job of talking yourself in circles. Now, we talked a lot about the fact that we are paying so much at the supermarket for so many goods. And now Coles has come out and said it's not entirely their fault, with suppliers and farmers doubling their requests for higher prices.
Yes. So higher labour and energy costs and supply chain problems have been the drivers of most cost increases, as have seasonal issues like weather and natural disasters. But in its submission to the Senate inquiry into supermarket prices, Coles says last year it received about 73 requests a week on average from suppliers to up their prices. Now, 2 years earlier, it was just 42 requests a week. Coles is a big company. It spends about $32 billion each year buying goods from more than 8,000 suppliers, and the average household spends about 10% of income on food and groceries. We're talking big business here. Coles said shoppers are definitely becoming more value conscious, but they really want people to realise that it's not just them, it's actually suppliers who are pushing up prices as well. In Woolies' submission, the grocer said shoppers were treated to high levels of competition and choice, and that, in fact, competition had intensified in recent years. Also providing a submission yesterday was Fruit Growers Victoria. Slightly different take, shall we say. They said the big supermarkets had so much power that they were being forced to sell fruit below the cost of production.
Sean, just staying quickly with Coles and Woolies, former Competition Commission boss Alan Fels took a fair swipe at the supermarkets and at Qantas as well yesterday, saying they're all charging too much.
Fels is the author of a report on price gouging commissioned by the Australian Council of Trade Unions. It concludes that supermarket power is exercised over farmers and many other suppliers, and gains in profit by the supermarkets aren't passed on. He said the local food and grocery sector is among the most concentrated in the world, and the Australian Competition and Consumer Commission should inquire into it. On Qantas, he said the national carrier is still price gouging, as illustrated in its blocking of Qatar's expansion without reasonable justification. Fels recommended the federal government use the opportunity of its current aviation review to remove restrictions on international and domestic competition.
Sean, the share price of luxury goods marketplace Cettire jumped 25% yesterday after the group delivered a strong first half result and said it's on the verge of breaking into China.
China, of course, is among the world's biggest luxury marketplaces, and Cettire plans to launch its own marketplace shortly. It has been going through a Chinese supplier, wants to do it on its own. Sales for the 6 months to the end of December jumped 89%. That was mostly about repeat customers. Boss Dean Mintz, who owns about 37% of the company, which means he's got shares worth about $530 million in Cettire, said trading in January had continued to be strong. He said high-end consumers are still spending. Cettire was founded just 6 years ago. It sells products from thousands of suppliers, acting as the intermediary between brands and customers. It doesn't have inventory itself. It just acts as that middle person.
Packaging group Amcor has axed 2,000 jobs, Sean, and is partway through closing up to 10 plants across the world as it cuts costs against a backdrop of slowing consumer demand for beverages and meat.
Volumes across the Amcor business in the December quarter sank by 10%, a record decline for the maker of bottles, wrappers and containers. Sales in the 6 months that ended December 31 dropped 9%, and interim net profit was more than cut in half. About half of the sales decline stemmed from consumers cutting back on items such as soft drinks and bottled beverages in North America, according to a report in Financial Review. The other half, which was a bit of a surprise, was the result of large pharmaceutical and medical device customers running down their inventories.
All right, turning to international news now. Singapore's biggest bank has cut its CEO's remuneration by about $4.5 million after the lender suffered a series of digital banking outages last year.
Now, keep in mind, when we talk about this story, the different outages that have occurred in the Australian banks over the past 12 months. Basically, the Singaporean outages led to the central bank reprimanding the DBA group, so it's fairly serious. His pay cut represents about a 30% reduction in variable pay for this guy. His name's Piyush Gupta. He's actually one of the highest paid executives in the country. The outages did result in payments and ATM transactions stalling across Singapore. It was pretty serious, but cut his pay by 30%. The management committees also had its pay cut by 21%. Now that's taking accountability seriously.
Certainly is. And now, one last one, Sean. Big pharmaceutical company, Eli Lilly, which is a very, very big company, but we do not talk about it anywhere near as much as we do a lot of the big tech companies on Wall Street. Well, it's giving some of those tech companies a bit of a run for their money, with its share price having doubled this year.
In fact, Eli Lilly is now bigger than Tesla. It's worth about $670 billion. Tesla, well, it's less than $600 billion nowadays. Still pretty good, up about 60% over the last year. But Eli Lilly, cracking company this year. The surge reflects investor confidence that Eli Lilly's obesity and diabetes drug portfolio will continue to grow rapidly. Obesity and diabetes are related, of course, and Eli Lilly is considered at the cutting edge of developing drugs to address both. The company this week said it's taking on its biggest expansion ever to try and manufacture enough drugs to meet demand. Its problem is it just can't keep up with demand for two of its drugs. The other big player in the market is Novo Nordisk. Earlier this week, it said it had bought 3 manufacturing plants for $11 billion. The obesity and diabetes drug business is huge and growing really, really fast.
Yeah, it certainly is. All right. Up next is the Fear and Greed Daily Interview. You are speaking today with Matthew Strotton, Executive Director at Real Asset Management.
I am, Michael, all about real estate investment trusts, what they are, the assets they include, what interest rates mean for them, etc. It's a great chat.
Yeah, it's a very, very topical conversation. It is well worth a listen. And of course, Real Asset Management is a supporter of Fear and Greed. It is up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Thursday, the 8th of February, 2024. Make sure you're following the podcast and please join us online on LinkedIn, Instagram, X and Facebook. I'm Michael Thompson and that was Fear and Greed Business News. Have a great day.